Let's go through this video because Ben Felix explains it very well.
The idea that covered calls generate income is financial bullshit. These strategies are mechanically expected to underperform their underlying equity and increasingly so at higher targeted levels of distributions. The problem for investors is that marketing these yields, in the case of covered calls, as income, or even worse, as expected returns, is financial bullshit. Selling a high distribution yield as an expected return ignores the fact that yields on covered call strategies are inversely related to their expected returns.
Yeah, that would be very foolish.
The combination of high distribution yields, lower expected returns, an uncapped downside. I looked for covered call ETFs with minimum 10-year histories. BMO has a few that launched in 2011. The BMO Covered Call Utilities ETF launched October 20th, 2011. It currently has a distribution yield of 7.37% compared to 3.43% for an ETF of the underlying equities. In periods where the underlying equities do not perform well, the covered call fund has been able to outperform, but these periods have tended to be brief and in the long run are far more than outweighed by the capped upside. Over the full history since inception, the covered call fund has trailed the underlying by an annualized 2.6 percentage points, and it has trailed the underlying in more than 70% of 3-year rolling periods with a 1-month step. Increasing the rolling window to 4 years results in the covered call fund trailing nearly 85% of the time. The underperformance is particularly pronounced when the underlying equities drop dramatically and then recover, which is a typical characteristic
because it's unable
of equity
to
returns,
participate in the upside.
They're more likely to be detrimental to most investors' expected outcomes than to improve them. Their high yields come at the expense of lower expected returns and historically lower realized returns. The volatility risk premium, which could theoretically help covered calls recoup their lower expected returns, has not been anywhere near sufficient to offset the reduction in expected returns since around 2011.